On this evening's program, tech stocks roared back today with blowout profits from Oracle and RIM. Now, RIM is up 10% in after-hours trading. Year-to-date, by the way, the tech sector is up 15%, and it does not look like a recession to me. But some disagree. We have Nouriel Roubini. He's chairman of Roubini Global Economics, a former senior official in President Clinton's Treasury. We have Brian Wesbury, chief economist at First Trust Advisors. Now, before we begin, it's time for some Kudlow 101 on the Goldilocks scenario. Everybody, we're going to give you three scenarios, sort of the good, the medium, and the ugly. Let's look at the good first up. Real GDP growth is on something of a roll, particularly in the last two quarters. Let's see if we can get this right. There's one, there's two. You're just about running at 4.5%. For 2007 as a whole, we're looking at a 3.1% rate. That is so far, and it doesn't look like a recession at all. This is Goldilocks at her finest. Now, here's the second chart. Not bad. I call this Goldilocks 2.0. Let me clear that for us. We can take a look. This is the Index of Coincident Indicators, just released today. It includes things like employment, production, and business sales, and disposable income. Now, it has slowed. There's no question about that. Clear circle. We don't seem to have the circle. Do we have the circle? There we go. It has slowed to 1.7%, so it's not as high as it was when it was up here at 3%. And to be sure, the direction is slower. But 1.7% after a couple of blowout quarters is pretty darn good. Now, let's look at the one that is the most difficult. These are the leading indicators, also came out today. Among the drops were money supply and stock prices and consumer confidence. And you can see we are down here minus 0.9%. These are 12-month changes. It is certainly a dangerous sign, given the fact that credit markets are clogged in short-term funding, the curve, the Treasury curve is inverted, and many money supply measures are showing flat growth. So let's discuss this. Nouriel Roubini, welcome back to the show. We haven't seen you in a while. Thank you for coming on. I want to ask you, what is your current thinking? Is a recession in the cards, Nouriel?
A recession in 2008 is inevitable. Already in this quarter, I think growth is going to be closer to 0 than 1%. In my view, at this point, the debate is not anymore recession or not, but how severe recession is going to be. Bill Gross says we're going to have a mild recession in 2008. Morgan Stanley says we're going to have a mild recession. Goldman Sachs and Merrill Lynch are saying we're going to have a recession. Alan Greenspan, Marty Feldman, Larry Summers. The debate has shifted away from soft landing versus hard landing to how hard the landing is going to be. In my view, it's not going to be a mild recession. It's going to be a severe recession because we have oil close to 100. We have the most severe liquidity and credit crunch. We have a housing recession getting worse, and we have a consumer without savings and with debt that is on the ropes. So we're headed towards a severe recession.
All right, Brian Wesbury, you heard Nouriel's opening points.
Right.
What is your response?
Well, after all that list, I just want to add that Brian Wesbury and First Trust is not seeing a recession. So you can add that to your list, Nouriel. We've been hearing this now for months, actually years, but really heavy-duty negativity for the last few months, and yet third quarter GDP was 4.9%. Do the math on the data that we already have for the fourth quarter. It looks 2% to me. The consumer spending, retail sales were up 9.4% at an annual rate in September, October, and November. That was the height of this credit crunch. And I don't see it. I think we're hitting some year-end pressures, but this is like Y2K. Once we break through that wall of December 31st, I think there's sunshine and good weather on the other side.
Nouriel Roubini, just let me ask you, for viewers, I ran the coincident indicators and I ran the leading indicators. In your judgment, Nouriel, how good are these indicators? Are these things that our viewers should actually be tracking?
They are certainly significant. In particular, the leading indicator of economic activity is a good signal of where the economy can go. yes, the third quarter was good, but bygones are bygones. In the third quarter, half of the growth was due to a buildup of inventory. That means that now growth in the fourth quarter is going to be closer to zero. And if you look ahead, you have to look at forward-looking indicator, not backward-looking indicator.
What's your favorite forward?
My favorite is things like asset prices, like bond market yields, about credit spreads. I think that currently the stock market is pricing more the suckers rally deriving by the expectation of the Fed essentially rescuing the economy. I think that's not going to happen. But those are some of the indicators I'll be looking at.
What about a quick response to Brian's point that what we've seen in recent months is pretty decent retail sales, Nouriel?
No, that's not correct. The real consumption spending in real term was 0.1 in September, was 0 in October. We don't have yet the number for November. It'll be slightly better. And now Shopper Track is telling us that retail sales have fallen for 3 weeks in a row in December. The holiday sales look like a disaster. So when you all add it up, real consumption growth is going to be close to 1% in Q4. Residential investment is collapsing. Durable goods orders have been falling for 3 months in a row. Where is growth? There is no growth in this economy. I don't see it. And we have the worst financial crisis in the last 20 years. This is the most severe liquidity and credit crunch we've seen in the last 20 years.
Brian,
it's getting worse.
Brian, what do you say about the inverted bond curve, which is a difficult one for me? Nouriel makes the point about the credit clogging up. The junk bond spreads have, of course, widened quite a lot.
Right.
And I just want to ask you also, we've seen quite a slowing in business profits. Now, I tend to look at the world through the lens of business. If business is profitable, then the economy expands and jobs and hence consumers have incomes. I am a little worried about profits. What's your take?
Yeah, well, there's so many things on the table here, Larry. Let me just point out that without housing, third quarter GDP was 6% annualized growth. And you have to remember that going back into the second quarter, Nouriel and others were saying third quarter was only going to have 2% growth. So these pessimists have been way, way wrong on the low side, and they've continually been blown out of the water by stronger than expected data. And I don't care what the weekly change store sales are saying and all of these things. We've constantly had revisions upward. We've constantly had better news. And I think all you have to do is go outside. You can't get a parking spot at the mall. You have to wait in line to get a table at a restaurant. You get middle seats on the airplane. There's no evidence that this economy is slowing down. Now, one of the things I'd like to point out is that the Treasury curve is inverted, but not the risk curve. And I think the Treasury curve is inverted because the Federal Reserve buys Treasury bonds when they inject money into the economy. Banks that are having some credit issues, and most of those money center banks are a little worried right now, they're buying Treasury bonds. And so what you have is this big demand for Treasuries which don't eat up any capital, and I think that's inverting the curve.
All right, what do you say, just to follow up,